Gary DeWaal here, and this is Bridging the Week for February 16th to 20th, and today is February 23rd, 2015. Good morning. A shortened work week in the United States because of President's Day, and a shortened work week in Asia because of the Lunar New Year, seem to have induced a light week of news impacting the financial services industry. However, during the week, CME Group sanctioned a number of firms for miscues in handling EFRPs and block trades, while FINRA brought an action against a broker-dealer for not following up on numerous AML red flags. We have just a few matters to cover this week on Bridging the Week, so let's get started. The CME Group brought and resolved multiple disciplinary actions against various members and non-members related to their alleged failure to follow requirements of the Commodity Exchange Inc. and the New York Mercantile Exchange in connection with exchange-related position transactions and block trades. Among the improper actions sanctioned by CME Group were the failure to maintain required documentation of the related position in connection with EFRP transactions, failure to timely report block trades, failure to report accurately the time of execution of a block trade, and misreporting exchange for swap transactions as block trades. Companies within one group, Marek Spectron, were subject to 4 separate disciplinary actions with sanctions ranging from $7,500 to $2,500 US. Other firms received within the same range and larger fines. Through these disciplinary actions, CME Group has highlighted once again the detailed rules that must be followed in connection with EFRP and block trade transactions. By the way, similar detailed rules exist on other futures exchanges too. EFRPs have strict requirements related to the nature of acceptable instruments that may qualify as the related position in an EFRP, record keeping, and reporting, among other matters. Block trades also have strict requirements related to minimum size, reporting, and using information derived from potential block trades. Check out the numerous articles in the block trades and EFRP category on the Bridging the Week website for articles on other exchanges, relevant rules, and other related disciplinary actions. Cobra Trading, a broker-dealer, agreed to pay a fine of $150,000 US to the Financial Industry Regulatory Authority to resolve a disciplinary action brought against it. FINRA charged that Cobra failed to adequately implement anti-money laundering procedures to detect suspicious activities and failed to have an effective customer identification program for new accounts. FINRA also charged that Cobra moved customer transactions into the firm's exempt error account so that its customers could avoid additional margin charged by Cobra's clearing broker on individual securities. Cobra's alleged wrongful conduct occurred from January 6, 2009 through September 3, 2013. According to FINRA, despite Cobra having written supervisory procedures that required it to follow up on various AML flags, Cobra failed during the relevant time to identify and conduct additional due diligence on one customer that rapidly liquidated low-priced securities at Cobra and transferred the proceeds abroad when public articles identified the customer as being involved in a securities fraud matter that resulted in charges by the Securities and Exchange Commission in 2009. One customer previously convicted of securities fraud who opened a joint account when the customer's release conditions only authorized the opening of an individual account, and wire transfers to a financial secrecy or high-risk location with no apparent business reason, among other matters. The Securities and Exchange Commission filed and settled an administrative enforcement action against VCAP Securities, a registered broker-dealer, and Brett Graham, its chief executive officer, in connection with VCAP's conduct of 5 auctions to liquidate certain collateralized debt obligations in 2012. According to the SEC, while conducting these auctions as liquidation agent for various CDO trustees, VCAP and Mr. Graham secretly arranged for a third-party broker to bid for the auction CDOs in order to purchase them for Vertical Capital, an affiliated investment advisor of VCAPs. Mr. Graham was also the portfolio manager and chief investment officer for Vertical. The SEC charged that Mr. Graham used confidential information VCAP was in possession of from other bidders to encourage bids placed by the third-party broker that was slightly higher than the highest bid from any other participant. After the third-party broker was successful with its bid, it would resell the relevant bond to Vertical at a slight markup. Vertical acquired 23 bonds as a result of these transactions. The SEC alleged VCAP's and Mr. Graham's conduct violated anti-fraud provisions of the relevant federal securities law and SEC rules. To resolve this complaint, VCAP agreed to pay disgorgement and prejudgment interest of almost $1.15 million US dollars, and Mr. Graham consented to pay disgorgement and prejudgment interest of $127,000 US dollars and a penalty of $200,000 US dollars, as well as other sanctions. The UK Financial Conduct Authority published the results of its review of asset management firms and how they control risk associated with the impermissible trading of equities based on confidential inside information, as well as improper disclosure and market manipulation. Although FCA concluded that all firms had established quote-unquote some practices and procedures to control the risk of market abuse, end of quote, the measures were comprehensive with only, quote, a small number of firms, end of quote. Accordingly, wrote FCA, quote, firms need to pay more attention to the possibility of receiving inside information through all aspects of the investment process and take steps to manage the risk, end of quote. Firms should also enhance their post-trade surveillance, warned the FCA. As part of its publication, FCA provided specific examples of good and bad practices various asset managers have taken to control the risk associated with insider trading. And finally, the Commodity Futures Trading Commission has scheduled a public roundtable on Clearinghouse recovery and resolution issues for March 5th in Washington, D.C. Among matters proposed to be discussed are the pros and cons of variation margin gains haircutting, reestablishing a match book, and when and how to conduct a Clearinghouse wind-down. Well, that's it for this week's Bridging the Week. As always, there is more information in each article, and more articles on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal, and for those celebrating Lunar New Year, Happy New Year, although please tell me, is it the year of the goat, sheep, or ram? Have a great week, and ciao!